All man's miseries stem from his inability to sit in a room alone and do nothing. All investment managers' miseries stem from their inability to sit alone in a room and do nothing. Charlie Munger likes to say that you don't make money when you buy stocks, and you don't make money when you sell stocks. You make money by waiting. And so the single biggest advantage a value investor has is not IQ. It's patience and waiting for the right pitch, and waiting for many years for the right pitch. If you study entrepreneurs, there is a misnomer. People think that entrepreneurs take risk, and they get rewarded because they take risk. In reality, entrepreneurs do everything they can to minimize risk. They are not interested in taking risk. They want free lunches, and they go after free lunches. And so if you study any number of entrepreneurs, from Ray Kroc to Herb Schultz at Starbucks, and to even Buffett and Munger and so on, what you'll find is that they have repeatedly made bets which are low risk bets, which have high return possibilities. So they're not going high risk, high return. They're going low risk, high return. And even with Bill Gates, for example, the total amount of capital that ever went into Microsoft was less than 50,000 between the time it started and today. That's the total amount of capital that went into the company. So Microsoft, you cannot say was a high risk venture because there was no capital deployed. But it had high uncertainty. Bill Gates could have gone bankrupt, or Bill Gates could have ended up the wealthiest person on the Forbes 400. And he ended up at the extreme end of the bell curve, and that's fine. But he did not take risk to get there. He was comfortable with uncertainty. So entrepreneurs are great at dealing with uncertainty and also very good at minimizing risk. That's the classic great entrepreneur. When you look at a business, look at it in a broader context of how it fits into the world. And sometimes if you can see it in a light that the world is not seeing it in, that can give you an edge. My degrees are in computer engineering. I spent a lot of time in the tech industry, and I like to say that I don't invest in tech because I spent time in it. I saw firsthand that the durability of technology moats is many times an oxymoron.
Quickly define moats in terms of a business that keeps competition away.
If you talk to Michael Porter, he would give you 5 books on what is meant by strategy and competitive advantage and durable competitive advantage. And if you talk to Warren and Charlie, they would just say it's a moat, and they'd break it down to one word. But basically, it's the ability of a business to have some type of an enduring competitive advantage that allows it to earn a better than average rate of return over an extended period of time. So some businesses have narrow moats, some have broad moats, some have moats that are deep but get filled up pretty quickly. So what you want is a business that has a deep moat with lots of piranha in it, and that's getting deeper by the day. That's a great business.
So you don't feel the need to pick 10 stocks a quarter or 1 stock a quarter, just what turns up?
Actually, I think that the way the investment business is set up, it's actually set up the wrong way. The correct way to set it up is to have gentlemen of leisure who go about their leisurely tasks, and when the world is severely fearful is when they put their leisurely task aside and go to work. That would be the ideal way to set up the investment business. Warren says that I'm a better investor because I'm a businessman.
Right.
And I'm a better businessman because I'm an investor. So the thing is that my experiences as a businessman have very direct long-term positive impacts on me as an investor, because when I'm looking at an investment, I now look at it like the way I looked at my first business, which is the first thing I'm looking at is how can I lose money on this? And can I absolutely minimize my downside? The upsides will take care of themselves. It's the downsides that one needs to worry about, which is why even the checklist becomes important. But so the important thing that value investors focus on is downside protection. And that's exactly what entrepreneurs focus on, is what is my downside. So that is I would say the crossover between entrepreneurship and investing, and value investing especially, is protect your downside.